Hey everybody, it's Pete Carmasino here at Chaikin Analytics. I'm the chief market strategist, and this is the halftime show. However, this is the last halftime show, and we're going on a great note. The markets are hitting new highs. Some of the narratives that I've been kind of pointing out over the years have played out pretty much to a T. Over the course of what's happening now in the presidential election year, we're going to see some volatility. There's no doubt about that, right? That's typically par for the course no matter what part of the presidential cycle that we're in. But during an election year, there's just a lot more noise. So typically that direction is up. We might see a move down a little bit. Today, we got some news that really hammered home a point that I probably started talking about right here on the halftime show. So I'm thankful for the ability to have been able to voice my opinions and thoughts and insights here on this Stockcharts channel. And maybe it's really, just good timing that this is the last show, the 100th show, in the day that the unemployment rate kind of ticked up back to 3.9%. But it also comes on the heels of Fed Chair Jerome Powell talking about rate cuts in the near future. Now, obviously, he probably knew the day, they couldn't tell us. And he's talking about inflation, right? Look at the inflation, card over here while he pulls the card out of his pocket over here. What I'm talking about is the unemployment. That's not what anyone's talking about. No one's really pointing out that saying we're waiting for unemployment to go higher to cut rates. Folks, I'll bring the chart up again today for the last time, but that's really when it's going to happen, right? When we start to see unemployment rising at a more rapid pace, 2/10 of a point isn't that big, from 3.7 to 3.9, starting getting to 4.5, 4.8, 5.0, I would imagine there's already going to be cuts on the table. Remember, Fed rate cuts do not come into a good market. There's something wrong, something slowing down. We're trying to fuel things with rate cuts. Now, a lot of stuff gets lost in the wash there, right? You've seen semiconductors, tech, all the big rally from 2023. Typically, we stall slightly, right, in a year like this presidential election year. When Fed rate cuts are on the table, that could change the dynamic, but certainly make it more volatile. Over the course of what's happening right now is we are starting to see that shift, even a little bit of a slowdown today as I record. We had a big move up, right? You typically get that pop, rate cuts, higher unemployment. It sounds counterintuitive, but the market understands the dynamic between rates and the economy. And at some point, reality sets in that says, wow, if they're thinking about cutting rates and unemployment is ticking up, that typically signals a slowdown. How bad of a slowdown? That's the problem. Nobody knows. Nobody can answer that. And you don't need to. You need to follow the trends. Just like when we were talking about defensives back in 2022, changing the guard onto the offensive side of the field, sort of the risk on trade. That's when everything in the Chaikin system flipped. We saw utilities, staples, and healthcare, not in that order, but almost in that order, sort of go bearish, where tech, XLK, XLC, and XLY, discretionary, were the last one to go bullish, started to go bullish in the very early days of January 2023. When you see that regime change, remember, if you can take anything away from my videos, remember, we want to follow the bond market, we want to follow interest rates, and we want to follow rotation between offense and defense. That risk on, risk off trade is a very excellent, very sophisticated way, very simple way to kind of follow the changes in the market. So I want to leave you with that. We're going to look at some charts. We'll go to that Fed chart that I've been talking about now for a long time. And again, how perfect is the timing that this is the last show here, and that maybe the narrative starts to play out actually today on March 8th. So let's dive into the charts and see what's going on. All right, first chart, economic research here from the St. Louis Fed, also known as the Fred website, kind of funny. So here's the chart. All I did was overlay unemployment rate in blue with the Fed funds effective rate in red. Okay, so you can see, we talked about this many times. If it's a repeat, I'm sorry, but this is my last show, so I want to hammer this point home, right? You're seeing unemployment rate move higher, right? Fed funds were already low here. That's when this started, right, in 1950. You start to see what's happening, right? You start to see the sort of bifurcation or divergence, whatever big word you want to use. One's going one way, and the other one's going the other way, right? That's what's happening. Here we are right now, way high on Fed funds rate, pretty low on unemployment rate. Today it ticked up to 3.9. Last month it was 3.7. You had revisions of more on less employed folks, which means there's more unemployed folks coming in from January. That moved this up. Now, if we continue to get revisions, we're probably going to start to see that 4% level, right? You start to see 4.6, 4.4. That's when the Fed funds started to get cut back when? 2007. Just remember that. So that's where that first recession, most recent recession came in. There was one here. It was brief. It was so brief you can't even see it. It's so thin. But you look at what happened here in all of these, and that's the narrative. Please take that away from my last show. I want to make sure that I hammer that point home. All right, let's dive into the charts on the ACP platform. All right, I can't leave without talking about bullish percent. So bullish percent here in the S&P Tech bullish percent index, or the technology index. Now, we're pretty well pinned, right? Pinned up here around that 80 to 87 point level, even sometimes as high as 90. That was back in July of 23. That's when things started to change, right? We started to see that change in January and February and March, even in April when discretionary was higher. And it really never broke down, only for really a brief moment. Why? Well, because we were talking about what? Potentially, higher rates. When that narrative changed, we saw a big move higher and haven't really paused since, except for a small drawdown there in February. Now, I just think we're a little too overbought, even though the RSI doesn't suggest that. That's a 21-day RSI. It's slightly kind of in the mid-range. Could it move under that 50? For sure. Maybe that's a good tell. But I think maybe you see a midpoint of this somewhere between, if this is 70 and 30, you're talking about, maybe that 50 level could somewhere be, a spot where it starts to mellow out a little bit. I don't know. Let's look at the 100. So the NDX, same kind of thing, a little bit more of a downward trajectory. We're definitely not in that range of above the 50. This is a 14-day RSI. I change them based on the indexes. That's another, I'll explain that a different time. But look at the volatility. Right? It's up and down, it moves all over the place. My point is that it feels overbought. Now, let's look at the original one, the bullish percent index, right? This is on the composite of the New York Stock Exchange. Pretty large number of stocks, not 100 or 500, but thousands of stocks. Not anywhere near overbought. So this is the bullish part of it, except RSI is getting pinned on the 14-day a little higher than it typically kind of lasts when it's up at this level. I'd like to see that get pinned above 70 or 75 when this is at 70. That would be nice timing for an overbought, kind of like what you see here. When you start to see these areas move into that range, you can almost set your clock by it that it starts to pull back slightly. So hopefully it's just a pullback and a healthy one. That's kind of the narrative that I'm looking at. All right, one of the last charts we'll look at here that I'm talking about recently, or should I say, for many years, has been the oil chart, and I'm just finding it right here. And we talked about this, right? I had to change this because these were getting so old. The charts were getting a little bit cluttered. So when you look at what we talked about, I talked about this back in 2022. Ironically, that's around when the market bottomed, by the way. White House talked about the White House buy zone. It really hasn't cracked that since. All right. People talking about the strength in oil. What's going on? What's going on? Well, this is what's going on. There's buyers down here and the world knows it. So when you get here, they can cut production and move the prices higher, and they can manipulate it a little bit. Depending upon how the elections turn out, this could change dramatically. If one candidate that we know is probably going to come in and maybe drill a little bit more, you might see the price of oil plummet, which could hurt it's sort of the distribution companies, but not the exploration and drilling companies. They might do really well. So keep that in mind. That's a different narrative for a different time, but one that could play out if this area is finally broken to the downside. All right. This is the New York NYSE Fang Plus Index, right? There's about 10 stocks in there. You can go look it up. It's your usual suspects, a few other ones. Like Alibaba and stuff like that. So just go look it up if you want to see what stocks are there. However, we hit a new high on this. It kind of topped out. This is a weekly chart. We talked about how rising rates and flattening rates were affecting this, and the narrative in rates when that changed. Look at that, October of 2023, when you saw the Fed pivot and all these things change. This took off, right? This was FOMO, end of year, rush to buy. I don't own enough. That was that move. That's where we're at. Could we pull back slightly? Why not? Why can't we? Why? It would be great. It would be an awesome opportunity. And we might see rates fall, right? And this might look out of balance for a little bit, but I think it will turn into a big trade once things cool off and the market has a little bit more certainty of what to A, expect maybe in the elections, and B, what to expect as far as slowdown, unemployment rate, and Fed funds rate, what's happening in that whole dynamic. If it's a little bit more clear, you'll get a better direction in this eventually. All right. And folks, this is one of the charts that I brought up a lot here during the course of the halftime show here on Stockcharts TV. This was sort of my call on bonds, and the TLT was sort of my proxy. I got it to the top of that range, didn't get actually to the target, but this is close enough for bond markets to be predicted as close as you get. Now, I drew all these sort of trend lines. This is some of my own internal work that I'm doing. I'm trying to see if there's going to be some sort of correlation to these lines. It looks like there is right now, but we'll see how that plays out. Now, if rates are going to get cut, what are bonds going to do, folks? Going to go higher. So that could also be the trade. When you start to see movement in sort of either the move index or multiple types of bond funds, you start maybe to look at the lower end funds. When I mean lower end, I mean not junk, but I mean shorter maturity, like IEF. You pull up an IEF chart, it's going to look very similar to TLT, but you might see a more movement here than you do on the TLT. Both will probably move directionally higher, but both have sort of some resistance at that $100 level. So just keep that in mind when rates start to get cut. These are going to be pretty decent trades, I would think. I would think that TLT could trade, again, depending upon when the rate cuts come, right? My target was 5.2 on this 10-year. I'm not going to get there. But if rate cuts come, we maybe could see a move to that 115 to 120 level, which would be a massive move from 95 or 96. Now, I don't know when that's going to happen. You're going to have to follow along and maybe follow me on Twitter. I'll be posting some more things on there. But just keep that narrative in mind as well. Rates lower. Obviously, rate cuts are going to be supportive for bond prices. All right. I just want to point out two things here, and then I'll look at the Chaikin system to look at these same two symbols. Look, when we started to see some changes here in the technology ETF XLK, right, we started to see moving averages. There were a lot of great signals that kind of coincided right around the same time frame, right? Beginning of 2023. Quite frankly, even at the end or October of 2022, we saw some things on the Chaikin system, and I can't let that go because they were excellent signals, and I think that's one of the reasons why you want to have the Chaikin power gauge at your disposal here on ACP. But looking at XLK, and then I'm going to flip over, look at XLU, this two-panel XLU chart. Now, right around this level, you started to see a breakdown in XLU, right around that sort of that October low where the market had a low, where you started to see XLK firm up. But look at the trade on the downside. When XLU versus the SPY went below sort of the moving averages here, when was that? That was the first week of January. Okay, you can see it on the actual chart of XLU here as well. If I jump back to XLK, when do you see this starting to move? You started to see these moving averages cross around in March. However, the XLK ratio really broke above that 55 EMA right around that same week that the XLU broke down, right? So you saw the transition from defense, right? From not being on the field, not trying to profit, not taking risk, to being on the field, going onto the offense, being on the field to try to score points. So you saw that narrative flip. And remember that, right? Remember that when in your trading environment, whatever you're seeing, go back and look at the defensive. Not saying not going to be a perfect indicator. I wish it was, but it's darn close. And it's really one that really talks about a larger narrative in the markets. All right. And lastly, again, I just want to look at the Chaikin system one more time to remind you of a few things, right? We've got an ETF rating. If you wanted to come and try this out, obviously you should. This takes into account the underlying components of these ETFs. All right. XLF is one that's obviously been bullish. You can see where the trend changes were back in November and getting into the December months. But look where Chaikin money flow came in. Look at the relative strength change. But the rating itself, you can see the rating here has changed almost on Halloween. That was that October low when we started to see that Fed pivot. So did XLK. So did XLY. Around the same, actually a little bit later there. XLC was more coinciding with a lot of these things. But you can see what I mean by these particular charts all changing trend around the same time in that 2023 level. Let me go back and look at XLK real quick. There's your 2023 change. That's what I wanted to show. And then even XLY was a little bit behind. Didn't happen until that April timeframe. April-March timeframe. When you look at XLU, you can see the breakdown on the 5-year well before the market lows, but around the market lows is when we went bearish. And so the ETF rating is something to consider. And when I go to any of these names, I'll look at XLK. When I open up the internal holdings of these funds, you can see where the rating, this bullish rating of XLK is coming from. You're looking at names like Salesforce, ANET, AMAT, Autodesk. All these names are really top performers, very bullish names in this index, and rightfully so. Look at the charts and look at how the Chaikin rating is picking up the changes in the narrative. All right, folks, I got a few more charts to look at. One of them is the S&P. So this is the S&P 500 index. As you know, over the years, I've been calling out the rallies, especially when we started to see the downturn. Now, what I did was I had a turning point here on December 28th, 2022, and I'll show you why I called that the turning point. The turning point here was, well, it never really broke that long-term trend on the weekly, which was great. The second thing was Rally 5 had a higher low than Rally 4. This, to me, was really the spot that signaled things were changing. Then Rally 6 also had a higher low and then produced a higher high. So this, between Rally 5 and Rally 6, set off into sort of the wild blue yonder and helped me kind of look for a target of 5,400, based off of some different moves here in metrics. This would be the biggest move of this whole sort of regime in the actual changing of the S&P on the upside. It's not there, but darn, did it get close. I think the high was somewhere around 5,200, 5,190, something like that. But boy, that's close enough. And I just wanted to at least document that before I left. One other chart I got to look at is gold, GOLD. Let's look at this one. Now, the interesting part is that I had a target here of $2,200. Now, folks, you might say, how did you have that set up? Well, I set it up about a year ago or so, and I didn't really call it out a lot because I'm not a real gold fan. I'm not really chasing gold or worried about what it's going to do or anything of that nature. Now, I built this target based off of weekly chart and how I saw things playing out. You can see that downtrend where once it broke, it never really broke above it. It never really got below it again, and that was absolute support. But I had that $2,200 price target, again, more from a weekly chart. Now, folks, it traded there today. Today, my last day here on the halftime show, I got a print of 2,200 on gold, and here, I'll prove it to you. Take a look on the live chart. It's 2193 right there, but the high was 2203 intraday. This is the highest level that gold has ever traded. So I just want to leave you with that. I wanted to document it a little bit and at least call it out and show that, we had it on here. I built it somewhere after I built this sort of cup and handle pattern, which again, the handle became sort of like a channel down that gold never broke, bounced off of it and continued the trend higher, again, hitting 2,200 today. My last day, my 100th show here on halftime at the Stockcharts TV channel. All right, folks, once again, I want to thank you again for tuning in. I appreciate all the comments over the years. I appreciate all the work behind the scenes with the Stockcharts folks helping me produce this. Denby's the person that I work with. He's been incredible. Thank you so much. Again, it was an honor and a privilege to at least have you listen to my insights. You don't have to agree with me all the time, but thank you for listening and tuning in. Leave me some feedback here, folks. The 100th show, the last show of the halftime show here on Stockcharts TV. I am Pete Carmasino, the Chief Market Strategist here at Chaikin Analytics, signing off for the last time. Take care, everybody. Good investing. But hold on, there's more. I will be back. Dave Keller promised me some spots here on the final bar. So make sure you tune in, and we'll be able to convey our insights again. And I look forward to doing that in the near future. Take care, everybody. Thank you again.